Have you ever landed in another country, grabbed a coffee, maybe looked at a pair of jeans, and just stared at the price, wondering, why it costs so wildly different than back home, even after you do the conversion in your head? It's a super common experience, right? And sometimes to really get a handle on something complex like currency exchange rates, you need a shortcut, a deep dive into the core ideas to get properly informed. Today, that's exactly what we're doing. We're diving deep into purchasing power parity, PPP for short. It's this fascinating concept that basically tries to tell us what an exchange rate should be just based on what your money can buy in different places.
hmm And our mission for this deep dive is pretty clear. We're going to unpack PPP from all sides. We'll look at its intriguing history, how exactly it's supposed to work, its applications today, which are pretty diverse, actually, and also why it's both powerful and, frankly, quite problematic in the real world. We really want you to grasp why market rates often wander so far off from this theoretical ideal, sometimes way off.
Okay. And we've pulled together a good stack of sources for this one. Articles, research papers, our own notes on PTP. You can rest assured we'll be extracting the most important nuggets of knowledge, trying to give you those aha moments along the way. Get you well informed, fast. All right, let's start unpacking this with something really intuitive. The law of one price. The basic idea is simple, isn't it? You can buy the exact same thing, an identical good, in two different countries. Well, once you adjust for the exchange rate, it should cost the same. Sounds almost too neat.
It does sound neat, yeah. Elegantly simple. And what's fascinating is how that simple idea then scaled up. PPP, at its core, it's a macroeconomic theory. It's trying to figure out the long-term equilibrium exchange rate between two currencies. And it's built on that exact principle you mentioned.
Yeah.
A unit of currency, say a dollar or a euro, should have the same purchasing power everywhere once you convert it. Think of it like a theoretical anchor. Something for real exchange rates to, gravitate towards in the long run.
So this elegant idea, who first really formalized it, made it this cornerstone of international finance. And why was it so important back then?
Well, the core idea actually goes way back. You can find traces of it in the 16th century school of Salamanca in Spain, believe it or not. But the person who really formalized it, gave it the name, and popularized it was the Swedish economist Gustav Cassel back in 1918. And the timing, the historical context, is absolutely crucial here. Think about it. Post-World War I, many countries had ditched the gold standard. They were facing wildly different inflation rates, often soaring. So when these nations started thinking about getting back to a stable gold standard, they needed a guide, a way to adjust their old pre-war exchange rates to reflect this new reality of purchasing power, massively changed by inflation. Cassel proposed PPP exactly for that, to calculate this new equilibrium rate. It was a practical tool for a really chaotic economic period.
Right. And I find this part really interesting. Cassel initially put forward a pretty rigid version, didn't he? This absolute PPP, basically saying the law of one price holds for a whole basket of goods. But I guess the real world didn't quite cooperate. What happened when the actual data started rolling in, showing things weren't matching up?
Exactly. Reality bit, as it tends to do. Cassel had to gradually adjust his theory. He started acknowledging that, real world stuff mattered, things like trade barriers, transportation costs, governments messing with exchange rates, pure speculation, even just what people expected to happen to prices. All these things caused deviations. He even sort of shifted his focus. Initially, he saw PPP more as a positive theory, like predicting where rates would go. But increasingly, he started emphasizing its role as a normative tool, a policy guide. In those big debates in the 1920s about returning to gold, Cassel argued, look, using PPP calculated rates as a reference for new gold parities, that's probably better for trade stability than forcing countries through painful deflation just to hit their old pre-war rates. It was pragmatic.
Okay, so less about perfect prediction, more about a sensible policy guideline for stability. And it wasn't just Cassel thinking along these lines, right? I mean, figures like John Maynard Keynes also saw the need to adjust for inflation, but they also quickly pointed out PPP's limits. Things like huge international capital flows, war debts, changes in how efficient workers were, shifts in global demand, all that stuff complicates it.
Absolutely. The theory was challenged by the complexity of global finance almost immediately. It wasn't a silver bullet.
Okay, so fast forward from the 1920s. Beyond the academic theory and the history, where is PPP actually used today? Why should you, our listener, really care about it now?
Oh, it has some incredibly diverse and impactful uses both in macroeconomics and in financial markets too. Probably its most widely accepted use today is for international comparisons. Think about big organizations. The IMF, the World Bank, the OECD, they constantly use PPP rates to convert things like GDP income figures into a common currency, often something called the international dollar. Why? Because it strips out the noise from volatile market exchange rates and those big differences in price levels, especially for stuff you can't easily trade, like haircuts or housing costs. The key insight for you here is that using PPP gives a much truer comparison of economic size, productivity, living standards. It helps answer who's really richer or poorer, beyond just the daily currency swings.
Right. So it helps compare apples to apples, economically speaking.
Exactly. Then in the Forex market, traders and analysts use it for currency valuation. It serves as a long-term benchmark, helps them gauge if a currency seems overvalued or undervalued compared to its long-run fair value based on purchasing power. And while it's not great for predicting next week's rate, many see PPP as a useful indicator for long-term forecasting, thinking trends over, say, 3 to 5 years or more. There's this underlying belief that eventually rates should move back towards that PPP equilibrium. Economic gravity, sort of.
And that leads to trading strategies.
Directly. These trading strategies look for those misalignments. If the market rate is way below the estimated PPP rate, maybe you buy that currency, betting it will strengthen long term. If it's way above, maybe you sell, betting it will weaken. It's very similar to value investing in stocks, looking for things that seem cheap or expensive relative to some fundamental value, assuming prices will eventually mean revert. In fact, in modern currency models, PPP often acts as a value factor. It flags currencies that might be a bargain or overpriced.
Interesting, like finding undervalued stocks, but for currencies.
Precisely. And one other quick application. Sometimes simple PPP indexes, like the famous Big Mac index from The Economist, they can be a quick, admittedly rough check. Sometimes used to spot, potential oddities in official inflation data. It's more of a fun snapshot, but it illustrates the core idea.
Okay, let's pull back the curtain a bit now. Look closer at the engine room, that law of one price. We said it sounds simple. But what are the core, really idealized assumptions needed for PPP to actually hold true? It sounds like we're building a perfect theoretical world here.
We absolutely are. It's a theoretical utopia almost. For the law of one price, and therefore absolute PPP, to work perfectly, you'd need, well, first, zero transportation costs. Imagine shipping anything, anywhere, for free. Then absolutely no trade barriers, no tariffs, no quotas. Goods flow completely freely. You'd also need perfect competition and perfect instant information for everyone, especially those arbitrageurs. Like an army of super shoppers who know every price everywhere, instantly, and can buy low, sell high without any friction, forcing prices to equalize immediately.
Wow, instant arbitrage.
Yeah. And finally, the goods themselves have to be perfectly homogeneous. Identical quality, identical features, or perfect substitutes. No brand loyalty, no subtle differences. Implicitly, it also assumes that massive capital flows or other non-trade factors aren't the main drivers of exchange rates, which is a big assumption today.
That definitely sounds like a perfect world. Frictionless. But the real world, it's messy. So how do these assumptions stack up against reality? What happens when they break down?
Oh, they break down constantly. That's really the crux of the PPP puzzle, why it often doesn't seem to work in practice, especially short term. Think about it. Actual transportation costs, always there. Trade barriers, part of life. Goods are rarely identical. Think quality differences, brands. A Big Mac isn't exactly the same everywhere, and a huge chunk of what we all consume is non-tradable. Housing, haircuts, local services, medical care, their prices are set locally. They can vary massively across borders. And that leads to something called the Balassa-Samuelson effect.
Balassa-Samuelson. Okay, what's that?
Basically, it suggests that richer, more productive countries tend to have higher overall price levels. Why? Because high productivity in their tradable sectors, like manufacturing, pushes up wages across the whole economy. So even your local barber in a rich country ends up charging more, even though their productivity might not have changed much. It makes comparing overall price baskets tricky.
Ah, I see. So high-tech factory wages pull up barbershop prices.
In simple terms, yes. Plus, information isn't perfect, markets aren't perfectly competitive. And crucially, today's Forex markets. They're dominated by huge investment flows, speculation, capital chasing returns, not just trading goods. These violations are exactly why PPP often fails empirical tests, especially over shorter periods. It's a fragile theory when you hit it with real-world complexity.
Okay, so given all these real-world problems, economists adapted, right? They didn't just throw the idea out. That's where the two main versions come in, absolute and relative PPP. Can you walk us through those?
Sure. So absolute PPP, APPP, that's the basic strict one we've mostly been talking about. This is the exchange rate adjusts. So an identical basket of goods costs exactly the same in both countries when you convert the currency. So the formula is simple. The PPP exchange rate is PPP equals the domestic price level divided by the foreign price level.
Yeah.
The key implication. The real exchange rate, the nominal rate adjusted for prices, should always be constant, often assumed to be
I
1.
agree, strict.
Yeah.
And probably doesn't hold often.
Rarely, if ever, perfectly. Which leads us to relative PPP, or PPP. This was developed to be much more practical. It doesn't demand that absolute price levels be equal. Instead, it focuses on the relationship between changes in exchange rates and changes in price levels, that is, inflation over time. So the approximate formula for small inflation rates is the percentage change in the exchange rate, delta, is roughly equal to the domestic inflation rate minus the foreign inflation rate. The main idea here. The currency of a country with higher expected inflation should depreciate against a currency with lower expected inflation, just enough to keep relative purchasing power stable.
Okay, so relative PPP is saying, basically, if prices in my country go up 2% faster than yours, my currency should weaken by about 2% over time to keep things balanced. Why is inflation the absolute key here?
You nailed it. That's precisely the logic. Inflation differentials are the engine driving relative PPP. Differences in price growth change the relative buying power of currencies. So the nominal exchange rate is expected to adjust, to move, specifically to offset that inflation difference. That's why RPP is generally seen as more testable and maybe more likely to hold true, at least over the long haul, compared to the super idealistic absolute PPP. It's a necessary compromise, really, trading some theoretical purity for a bit more real-world relevance.
Makes sense. It acknowledges change rather than demanding static perfection. Now, PPP is clearly foundational, but it's not the only game in town, right? It doesn't exist in a vacuum. How does it connect or maybe contrast with other big currency valuation models that people use?
That's a great point. It's important to see how these models fit together or where they differ. They often offer different perspectives, different time frames. Let's look at a couple of key ones. First, there's interest rate parity, IRP. Its focus is totally different. Financial markets, capital flows. It connects the difference in interest rates between two countries to the difference between the spot exchange rate and the forward exchange rate. It's all based on risk-free financial arbitrage.
So making sure you can't just make free money by borrowing low, investing high, and converting back without risk.
Exactly. IRP is considered a short-term equilibrium condition. In developed markets, it holds almost continuously because arbitrage is so fast and efficient. That's a huge contrast with PPP, which is about goods, inflation, and long term. There is an indirect link, though. It's called the International Fisher effect. That suggests interest rate differences often reflect expected inflation differences. So higher interest rates might signal higher expected inflation, which, according to PPP, should lead to currency depreciation down the line. So they sort of align in the long run, theoretically.
Okay, so IRP is short-term finance, PPP is long-term goods. What else?
Then you have something called the Behavioral Equilibrium Exchange Rate, or BEER. This is a more complex beast. It tries to explain long-term movements in the real exchange rate, the one adjusted for prices. BEER connects that real rate to a whole set of underlying economic fundamentals. Things like productivity differences between countries, the terms of trade, how many foreign assets a country holds, long-term real interest rates, government spending.
So it's looking deeper than just prices.
Yeah, much deeper. You could almost see BEER as an extension or a generalization of TPP. While PPP often assumes the long-run equilibrium is kind of fixed, BEER allows that equilibrium to actually move over time, driven by these changing fundamentals. It's way more complex, needs a lot more data, more sophisticated statistical techniques.
Got it. So rather than competing head-to-head, these models are like different tools in the toolbox, offering different lenses.
Exactly. That's the best way to think about it. PPP, long-term goods market equilibrium. IRP, short-term financial market equilibrium. BEER, explaining why the long-term equilibrium itself might be shifting based on fundamentals. Which one you use or emphasize really depends on what question you're trying to answer or what kind of time frame you're focused on. They're all pieces of the currency puzzle.
All right. Theory is one thing, practice is another. Does PPP actually work when the rubber meets the road, especially for something like currency trading? This brings us to backtesting, a crucial step. How on earth do you even start testing a long-term, sometimes fuzzy concept like PPP rigorously?
Backtesting PPP. Yeah, that requires serious rigor, especially with the data. And this is where, the real practical challenges bite. First off, Data is absolutely king. You need a ton of historical data and the right kind. You need spot exchange rates, the actual market prices from reliable sources like Bloomberg, Refinitiv, maybe central bank databases like FR And crucially, this data needs to go back a long way, 10, 20 years, maybe more, to capture PPP's long-term nature.
Right.
You obviously need price inflation data. CPI is common, maybe PPI or GDP deflators, sourced from national stats agencies, OECD, IMF, World Bank. And sometimes people use the official PPP data, those survey-based estimates from places like the OECD or the World Bank's International Comparison Program, ICP. These are often used as benchmarks, maybe anchors for absolute PPP calculations.
All right, but you mentioned challenges with that official data.
Huge challenges. The biggest one is latency. That official survey-based data. It often comes out with massive delay, sometimes years late, and even then, it can get revised later. This is a nightmare for backtesting accurately. You absolutely cannot use data in your test that you wouldn't have actually had at the time you were supposedly making a trade decision. That's called look-ahead bias, and it invalidates your results.
Right, you can't cheat using future information.
Precisely. So the data collection and pre-processing is intense. You gather data, you clean it meticulously. Handling missing values is key. Often you use forward fill for time series, just carrying the last known value forward to avoid using future info. Remove duplicates, check for outliers. Then you integrate data from different sources, transform it, calculate inflation rates, log returns, and crucially that PPP deviation percentage. How far is the market rate from the theoretical PPP rate? And remember, every little decision here, how you handle missing data, which price index you use, involves assumptions that will affect your final results.
Okay, so the data's prepped. How do you set up the actual backtest to be robust?
Right, setting up the backtest. First, long time frame, as we said, 10, 20 plus years to see full cycles. Second, avoiding overfitting is critical. That's where your strategy looks amazing on past data but completely bombs live. The key is splitting your data in sample for developing the strategy, out of sample for testing it on completely unseen data. And even better, use walk-forward optimization, WFO. This is standard practice now for time series stuff like currencies. It simulates reality much better. You optimize your strategy rules on a chunk of past data, then test it on the next chunk of unseen data, then slide the window forward and repeat.
Why is WFO so important?
Because it stops you from implicitly curve fitting to the entire history at once. It forces the strategy to adapt, or fail, as market conditions change over time, just like in real trading. It gives you much more confidence that your results aren't just a fluke of the specific historical period you tested on. Then, realistic assumptions. You have to account for trading costs, spreads, commissions, slippage, and for long-term holds like PPP strategies, overnight financing costs, swaps, or rollovers can be significant. Ignoring these can make a losing strategy look profitable. And finally, avoiding biases. We mentioned look-ahead bias. Also, survivorship bias, only testing on currencies that still exist today, ignoring ones that might have disappeared or blown up.
Wow, that's incredibly meticulous. A lot goes into a proper backtest. So let's say we've done all that hard work, we've run the backtest. What do the results actually tell us about how well PPP works in practice? What does success or failure look like in the numbers?
Good question. The first thing you usually do is a visual comparison. Plot the actual spot exchange rate against your calculated PPP rate over time. Say for euro and USD, what you'll typically see isn't a perfect match. Instead, the spot rate tends to oscillate, sometimes wildly, around the PPP line. This chart is great for identifying periods of significant misalignment. Like you can clearly see the euro was way undervalued versus the dollar in the early 2000s by most PPP measures. Then it swung to being overvalued before the 2008 crash. More recently, it's often traded below its estimated long-term PPP, which some put around 1.20 or even higher. Those gaps, those misalignments, that's the potential trading opportunity the strategy tried to capture.
Okay, so you see the divergence visually. What else?
Yeah. Next, you dig into performance across market cycles. You absolutely need to see how the strategy performs, looking at things like annual return, Sharpe ratio for risk-adjusted return, and maximum drawdown, which is the biggest peak-to-trough loss during different market conditions. Bull markets, bear markets, sideways grinds. Why? Because PPP is fundamentally a mean reversion idea. These strategies often do best when markets are ranging or slowly converging back to perceived fair value. They can really struggle, maybe lose money for long periods during strong, persistent trends where the market just keeps moving further away from PPP.
So it might work sometimes, but not others.
Potentially, yes. Although, there's an intriguing possibility sometimes discussed. Could value strategies in currencies like PPP-based ones act as a kind of hedge during big market crises? The idea is they might have low or even negative correlation with traditional assets like stocks during downturns. So maybe they provide some diversification benefit. It's not guaranteed, though. Depends heavily on the specific crisis and market dynamics.
It's interesting. A potential diversifier. What about stability? How do you know if the model itself is reliable?
Right, model stability and reliability. Several things to check here. Parameter stability. Do the best settings for your strategy rules, like what deviation threshold triggers a trade, stay reasonably consistent over time? Walk-forward optimization really helps assess this. If the best parameters jump around wildly period to period, the strategy might not be stable. Sensitivity analysis. How much do your results change if you tweak your assumptions? Higher transaction costs, different inflation measure. A robust strategy shouldn't fall apart if you change minor assumptions. And the absolute acid test. In-sample versus out-of-sample performance. How did the strategy do on the data it hadn't seen during development? If there's a massive drop in performance out of sample, that's a huge red flag for overfitting. It means the strategy likely learned noise, not a real edge, and probably won't work going forward.
So good out-of-sample performance is key.
Absolutely crucial. But one big caveat on reliability with PPP. When we talk about reliability here, it usually refers to the belief in that underlying long-term economic pull purchasing power convergence, which does have some empirical backing. It does not mean you should expect a smooth, easy, consistently profitable ride. Because of that super slow convergence and the long periods rates can stay misaligned, traders using PPP might face, long stretches of flat performance or even painful drawdowns while they wait for the market to maybe eventually come back to PPP. It definitely requires patience.
That really does sound like a game for the truly patient investor or trader. So, okay, if you are that patient long-term player, how might you actually translate all this theory and backtesting into a tangible, real-world trading strategy? Can you give us a simple illustration?
Sure, let's sketch out a simple, illustrative long-term strategy using USD based on that PPP deviation we've been talking about. For entry signals, you'd look for significant deviations. Maybe you decide to buy USD, go long, when the actual exchange rate drops, say 15% or 20% below the calculated PPP rate. The signal is the euro looks substantially undervalued by PPP, so you expect it to strengthen eventually. Conversely, you might sell USD, go short, when the rate goes maybe 15% or 20% above the PPP rate. Signal, euro looks overvalued, expected to weaken over time.
Pretty clear entry rules.
Yeah.
Based purely on that deviation number.
Right. And you could add other filters, maybe confirming with a long-term trend indicator or something, but the core signal is the PPP misalignment. Now, exit signals. For take profit, the logical exit is when the deviation gets back close to zero, or equilibrium, maybe within a band like -2% to +2%. The misalignment has corrected. But stop losses are absolutely vital here, precisely because convergence is slow, and rates can move against you for a long time. A stop loss could be based on volatility maybe 2 or 3 times the average true range away from your entry, or based on key technical price levels on a chart. Or you could even have a maximum deviation stop, like if you went long and negative 20% deviation, maybe you cut the trade if it somehow drops to negative 30%. Another option is a time-based stop. If the trade hasn't hit its profit target after, say, 2 or 3 years, maybe you just close it out. Sometimes the convergence just doesn't happen in a reasonable time frame.
Right, you need multiple ways to protect yourself.
Definitely. And crucial for any strategy, position sizing. You absolutely must manage risk. Size your trade so that even if your stop loss is hit, the loss is only a small fraction of your total capital, maybe 1% or 2%. This protects you from blowing up your account on one bad trade, especially when trades can last years. And the frequency here, this is not day trading. You'd likely evaluate the strategy monthly or even quarterly, check the deviation, see if signals are triggered. It's about setting positions based on long-term value and then letting those slow economic forces hopefully play out.
Okay, that gives a concrete picture. But that patience requirement, the need for wide stops, it really highlights the difficulties. What are the biggest remaining hurdles? The major puzzles that PPP still throws up in the real world for traders and economists alike. What makes it so notoriously tricky?
Yeah, the challenges are significant and widely acknowledged. The number one issue is what economists call the PPP puzzle, which is simply that incredibly slow convergence. Even if rates do eventually revert to PPP, the process takes ages. Empirical studies often estimate the half-life of a PPP deviation, the time it takes for half the gap to close, at 3 to 5 years. Some studies find even longer. That drastically limits its usefulness for anyone not operating on geological timescales.
3 to 5 years just for half the gap to close.
Yeah, it's slow. Then you have the real-world frictions, transaction costs and trade barriers. They create this sort of neutral band around PPP, where small deviations just aren't worth arbitraging away, so rates can drift within that band. The huge role of non-tradable goods and services, housing, local services in our price indexes is another big one. Their prices are set locally, driven by local wages and demand. Remember Balassa Samuelson. Exchange rates struggle to equalize overall price levels when such a big chunk isn't internationally traded. Comparing identical baskets is also hard due to differences in quality and consumption patterns. Is a basic car in India truly comparable to a basic car in Germany? Are consumption habits the same? It's tricky.
Sure, a basket of goods isn't truly standard globally.
Not really. Then there's government intervention. Central banks buy and sell currency, affecting rates. Fiscal and monetary policies influence exchange rates, often pushing them away from where PPP might suggest they should be. And perhaps the biggest factor, especially since the 70s and 80s, the sheer dominance of financial market factors. Modern Forex is driven overwhelmingly by massive capital flows, investment, speculation, interest rate differentials, investor sentiment, risk appetite, news flashes. These short-term drivers can completely swamp the slow, gradual pull of PPP for long periods.
So capital flows just drown out the trade flows that PPP is based on.
Often, yes. Add to that, persistent data issues, getting timely, accurate, consistent global price data is hard. Those lags and revisions in official PPP data, for instance. And finally, during periods of really volatile markets and macro shocks, think 2008, think the peak of the COVID pandemic, exchange rates get dominated by pure fear, sudden flights to safety, massive capital shifts. In those extreme times, PPP basically goes out the window as an explanatory or predictive tool. At its heart, PPP is a simple static equilibrium model based on goods markets, the real Forex market. It's a dynamic, incredibly complex system, driven by fast-moving finance, changing expectations, sometimes irrational psychology, relying only on PPP to navigate that market. It's like trying to steer a ship through a hurricane by only looking at a lighthouse miles away on the coast. It tells you the general long-term direction, maybe, but it doesn't help you dodge the giant waves hitting you right now.
That's a powerful analogy. Okay, so let's try to wrap up this deep dive. Purchasing Power Parity. It's clearly a cornerstone of international finance, a simple, very intuitive theory suggesting currencies should adjust to equalize buying power across borders. It's powerful for those big-picture economic comparisons, giving us a truer sense of relative wealth. And it even forms the basis for some very patient long-term value strategies in the currency markets.
Absolutely. Yet it embodies this fascinating paradox. Despite its elegant simplicity, despite some real-world uses, its strict assumptions almost never hold true in reality. This leads to those persistent deviations from theory and that famous PPP puzzle. Why does it take so incredibly long for exchange rates to revert, if they even do?
Which leaves us with perhaps a provocative thought to mull over. What if this persistent puzzle, this slow convergence, isn't really a flaw in the core logic of PPP itself? What if instead it's a reflection of just how fundamentally different, how much more complex and finance-driven our global economy and markets have become since Cassell first formalized the idea a century ago? How much further can prices and exchange rates diverge, and for how long before that old economic gravity truly takes hold again?
That's a great question to ponder. And if you, our listener, are feeling extra curious after this discussion, maybe go look up The Economist's Big Mac Index. It's a fun, real-world, simplified take on PPP in action. Or, if you really want to dive into the weeds, explore the World Bank's International Comparison Program data. It's a treasure trove of global price information, the raw material for serious PPP analysis.
Lots to think about there. Thank you for joining us on this deep dive into the world of purchasing power parity.